In this video, we're going to ask 6 critical questions an investor should be able to answer before buying a stock. We'll show you how in minutes you can answer them with Market Grader's help. The first key question: what is the overall financial strength of a company whose stock you're considering to buy? It's important to understand that when you're buying a stock, you're buying a piece of a business which entitles you to part of its future earnings, based, of course, on the number of shares you own. Therefore, knowing about the company's health to determine what to expect for its future prospects is essential. Market Grader shows you in seconds the fundamental strength of any company based on a rigorous yet simple grading system. We grade every company from a growth, value, profitability, and cash flow perspective. Each one of these categories is comprised of 6 individual indicators, all graded with a letter ranging from A+ to F. These 24 grades are summed up into a final overall numerical grade ranging from 0 to 100. This final grade is representative of the company's overall financial strength and its valuation. It determines our buy, hold, and sell rating, and it also allows you to compare the financial health and investment merit of very different companies and their stocks regardless of size, economic sector, industry, or business model. Any company an investor buys should have good scores across all categories of our analysis. Our overall grade is based on a balanced analytical approach to ensure this is the case. A company that has strong grades in growth, profitability, and cash flow, but a poor value grade, for example, should raise a red flag among investors. The stock's potential may already be reflected in its price and have gotten ahead of the fundamentals. While the stock price may continue to rise, propelled by its momentum, a minor disappointment in an earnings report, poor guidance by management, or an analyst downgrade could send the stock tumbling down dramatically. On the other hand, a company with a strong value grade but poor growth grades is also a red flag. It might appear like a good value play, but in reality it could be a value trap. While it is important to find the right balance between growth and value, our profitability and cash flow grades are also very important in understanding and measuring a company's health. They help you to see just how good the company is compared to its peers, how much money it makes, and generally speaking, whether it's well managed. While Market Grader's overall grade and rating incorporate a balanced grade approach, our system equally allows you to grade any company from the perspective of growth and value, independent of one another. Whatever option you select, that's the area our analysis emphasizes while always factoring in profitability and cash flow. When the difference between the overall growth and value grade begins to widen significantly, it becomes clear that an imbalance is developing that should serve as a warning sign. Eventually something will give, either an unsustainable growth rate or an unjustified valuation, for example. This is an important concept for investors to understand and, more importantly, track. 2 of our idea generators flag such companies, as you may see on the screen. The second key question to ask is whether the company's margins are expanding or contracting. A good way to understand a company's financial performance is by looking at its margins, particularly their evolution over time. Market Grader looks at a company's gross margins, EBITDA margins, operating margins, and net profit margins across trailing 12-month periods. Our system calculates the speed at which they are contracting or expanding and the magnitude of the changes and incorporates these values into our growth, profitability, and cash flow analysis. And since margins vary significantly across industries and sectors, given the diversity of business models amongst all companies covered by Market Grader, our system also compares every company's margins against its peers' average margins. Our margins charts allow you to see just how they have changed from one year to the next, based on quarterly and trailing 12-month periods in order to smooth out short-term fluctuations of the business cycle. Investors should be looking for companies that are expanding their margins while growing their top-line revenues and bottom-line net income. You may define your own minimum margin parameters when looking for companies that meet your desired criteria by using our advanced search function. In it, you may select the margin levels you're looking for and combine them with specific revenue and net income growth rates, in addition to, of course, our own grades, ratings, and indicators, as well as individual fundamental filters. The third question you should ask is whether the company is diluting its shareholders or buying back its shares, and what impact does this have on earnings per share. The amount of shares a company issues to new or existing shareholders, or the amount it buys back or retires from public circulation, has a direct impact on its earnings per share and therefore the value of its stock. Yet, this is seldom reported or followed. These policies also speak volumes about a company's corporate practices, its regard for its shareholders, and management's view of its future prospects. Market Grader's dilution analysis regularly measures the change in every company's number of shares outstanding and calculates them down to the last cent, the impact on earnings per share. In our earnings and dividends page, investors may see the amount of common shares outstanding used to calculate earnings per share every quarter for the past 5 years. A historical common shares chart makes it easy to identify share issuance or share buyback trends. In the chart above it, investors may see the actual impact of the company's dilution or buyback policy on earnings per share reported for each of the last 8 quarters. One of the small charts in this section displays the company's earnings per share on a fully diluted basis compared to what it reported a year earlier and what the latest report would have been if no dilution or buybacks had occurred in this time frame. The nearby table breaks down the numbers and displays the impact a change in shares had not only on reported earnings per share, but also on the advertised growth rate. It's important for investors to be aware of companies that may generate earnings growth simply from buying back shares and not from their core operations. Good examples of companies that diluted their shareholders considerably in recent years are many of the banks and financials that were forced to raise capital during the 2008 financial crisis. While the capital raising efforts were given wide media coverage, the ultimate impact they had on existing shareholders got lost in the headlines, and interest in this faded with time. Market Grader shows how much existing shareholders lost from these dilutions. Conversely, for companies that have in place extensive buyback programs, Market Grader quantifies how much of their earnings per share reported every quarter can be attributed to a shrinking share base. The fourth key question to ask is whether the company's financials are improving or deteriorating. It's such a daunting task for investors to do a thorough analysis of a single company before deciding to buy its stock that closely following a company's financial performance quarter after a share purchase seems almost too much to ask. Yet this is exactly what investors need to do in order to keep their portfolios up to date, not to mention doing it for thousands of companies across diverse industries and sectors when looking for new investment opportunities. Picking a stock is only half the battle. Following the company's development and the impact its financial performance has on the stock and knowing when to sell or to buy more is the other half. Market Grader enables you to do this with several unique tools. Our snapshot report shows investors the impact a company's quarterly results have on its fundamental grades. It shows clearly and across time whether the company's top and bottom line are growing or shrinking, whether its margins are expanding or contracting, and generally speaking, whether its financials are improving or deteriorating. It also shows, of course, whether the stock's valuation is keeping up with the fundamentals or instead getting too far ahead of them. Our dashboard and morning brief emails alert our subscribers about rating changes, sentiment changes, and earnings reports for companies they follow in their portfolios or watch lists. MarketGrader.com subscribers can follow up to 1,000 stocks using 5 portfolios and 5 watch lists. The fifth key question to answer is how does your company compare against its peers? It's a common mistake investors make to assume a $10 stock is cheaper than a $100 stock. The question they should be asking themselves in this case is how does the value of these two stocks compare relative to each company's fundamentals? Market Grader's side-by-side analysis lets investors compare 3 stocks from top to bottom. The analysis allows them to compare the company's sector and industry ratings, their sentiment ratings, their investment profile ratings, and of course, their fundamentals. The report compares side-by-side the company's revenue and net income growth rates, their margins, return on equity, capital structure, and valuation ratios. More importantly, the analysis allows investors to graphically compare each company's areas of strengths and weaknesses based on our unique fundamental quadrant. In addition, every day, Market Grader ranks all sectors, industries, and sub-industries from top to bottom based on our overall fundamental grade and our sentiment rating. These lists not only help investors see where their stocks rank relative to their peers, but also help them find new ideas from higher-rated companies. And the last key question is, what does the company look like from the top down? It is not uncommon for the stocks of companies with poor fundamentals to move up in price in the short term, or conversely for higher-rated stocks with strong fundamentals to have downward price swings, usually also in the short term. So why does this happen? Market Grader's top-down analysis helps to answer this question. Well, Market Grader's primary focus is on finding strong, well-managed companies that consistently create economic value to build significant shareholder value in the future. We also understand that many other factors play a role in the performance of stock prices in the short run. For example, generally speaking, in the short run, stocks tend to move in tandem with their peers. If a company reports poor earnings, investors may be inclined to sell some of its competitors' shares as well, fearing industry-wide problems. In other cases, investors will anticipate changes affecting entire sectors based on a fluctuation in the business cycle. As such, they will move in and out of defensive stocks en masse, affecting companies with strong and weak fundamentals alike. In many cases, general market momentum or investors' moods will contribute to overall trends both on the way up and on the way down, lending credibility to the old adage that a rising tide lifts all boats. In this case, it can also sink all boats. Market Grader's top-down analysis is divided into three sections that together complement our fundamental or bottom-up analysis. At the first level, or 50,000-foot view, our sector analysis measures the overall price trend of each of the 10 sectors we cover. This helps investors understand the overall direction of the wind for the broadest segments of the economy. At the next level, our sub-industry analysis also measures the overall price trend and momentum for each sub-industry that we cover. Since each sub-industry is much more concentrated in groups of companies with similar business models and products than an entire sector, this analysis helps investors understand if they're riding in an elevator that's going up or on the way down. Market Grader covers more than 150 sub-industries. The final section of our top-down analysis is specific to each individual stock and focuses on measuring overall investor sentiment. Based on 4 individual grades, our sentiment indicator measures stock price trend and momentum, a stock's relative strength compared to all other stocks in the market, changes in earnings guidance by the company, and fluctuations in short interest that are essentially bets the stock will fall. All these are encompassed into a final sentiment score and a positive, neutral, or negative signal. Once an investor has answered these 6 questions about a stock he owns or intends to buy, he can rest assured of having done the necessary homework to succeed in the stock market. Market Grader's goal is helping investors achieve such success in the long term.